Matthew joins us now, Head of Investment Research with Julius Baer. Mark, good morning. Thank you for joining us. Mark, it's turning out to be a good and a decent year for global equity markets. And just when it appeared that concerns around recession, concerns around what valuations they will come and hit global markets, I think things are looking quite decent actually so far. Can I use the word so far, or will it be really far before we see a sign of correction?
Well, we were anticipating a correction around now, and we thought the CPI reading for January could be a catalyst, but of course the market was up last night. So maybe when NVIDIA reports on Wednesday, if for any reason their actual results or guidance are not quite as good as what people think, we could have a correction, but I must say that at least for now, the market seems very strong.
What is driving the market? Do you think this is pure concentration which is happening in, let's say, in those magnificent seven, and those seven stocks, they keep on going higher, and the market in a sense is just moving because of that entire concentrated factor?
I believe that the main reason is the Mag 7, as you say, their earnings growth year on year. We're missing one, as I said, NVIDIA doesn't report until next week, but if we use the consensus estimates for NVIDIA, the aggregate year-on-year profit growth of those seven stocks will be 49%, which is, of course, an incredibly strong number. And that is, you're right, what's driving the market.
Right. So, Mark, just wanted to understand, what really is the construct right now? And I'm going to keep the US equities outside of the ambit, but the call on China, for instance, wherein a meaningful recovery seems still far away. Japan, as we speak, has already slipped into recession, losing its third biggest economy title already. How do you think the Far East is panning out?
I wasn't aware that Japan's in recession. I have no comment on that. Kind of surprises me. I mean, their economy seems good to me, but the big one, of course, is China, and I think there's a kind of what's the word for it, incongruity in a lot of what we're seeing in China, because on the one hand, the consumer confidence is clearly extremely weak, as is business confidence. But on the other hand, there are anecdotal signals that at least somebody is out there spending money. The cinemas are full, domestic tourism is very strong, and there's several other things like that. I would say with China that it is still going to be weighed down by all of the regulatory changes and corruption crackdown, etc. The uncertainty of the policy, which has just been, you wake up one morning and you don't know what it's going to be. But on the other hand, on the 22nd of January, the Prime Minister said that they want to stabilize the stock market. And in China, the concept of face is a very important concept, and you don't want to lose face, don't want to embarrass yourself. So if they allow the stock market indices to go significantly below where they were on the 22nd of January, that's a big loss of face. And so I guess what I'll say, just to round off my thoughts, is on the one hand, the economy is still pretty bad because of a lot of the policy. But on the other hand, they've said that they want the market to be stable. And so I think that it will be stable, actually.
Good morning. Wanted to understand from you as well what the next big imminent or inherent risk could be for the Indian markets. Do you think that it's largely likely to emanate from geopolitical concerns or fears of a slowdown across the globe, or that it could be something domestic?
I struggle to identify a risk in India, and so I'm sure there are many risks out there that could pop out suddenly, and I just can't identify one. I suppose that there was a lot of foreign inflows at the end of last year, and if for whatever reason those foreigners wanted to sell, that could certainly push the market down. I don't really see the reason why they would want to sell. Of course, if you have a big global sell-off, history shows us that global investors tend to de-risk in emerging markets. And so if there's a big global sell-off, I do believe India would be part of that now simply because quite a lot of money went in that in the last few months of last year, and it is, let's face it, fairly fair weather friend type money. And I mean, it will leave if it worries about risk.
Right. Mark, also wanted to get a sense, when it comes to India, you think the big trend would be to stay within financials? And I ask because, financials have taken a bit of a backseat, so to speak. It's actually the capex-driven themes, government-owned companies, which actually have been performing rather well, as opposed to what banks in particular, for instance, have been doing.
Yes, you're right. And so precisely because of that underperformance, we like them. They're inexpensive, and they are indirectly a proxy on the capex story, in the sense that if companies invest more in factories, for example, or if there's more infrastructure built, ultimately some of that will have to be financed by loans from banks. So I think they're still an integral part of the Indian growth story. And yeah, we still like them. They're our first port of call in the market.
What's the outlook then when it comes to the entire IT basket, owing to the kind of quarterly performance that they have delivered? Do you believe that this is a space best avoided?
Yes, we're not big on IT because we're sensing a lot of delays in the American companies. They're not coming through on the commitments they've made for various business deals with the Indian IT sector. So IT has always been a leveraged play on the US. And I suppose I'm contradicting myself a little because we do like the US market. But I would rather, if I'm invested in India, just be invested in the Indian domestic story. I can get my US exposure in the United States itself.
Indeed. Okay, Mark, great to have you on the show today. And I can see it's quite a rainy Singapore behind you.
Yeah, it is just rainy the last hour.
Right. Okay, great. Great speaking with you on the show as always.